So you spent 30 years building your portfolio. You're diversified, you rebalanced, maybe even maxed out your RSPs and your TFSAs along the way. But here's the trap. Just because your investments look good on paper doesn't mean they're actually in the right places. And for many retirees, that simple detail, what's held where, can quietly cost six figures over time. And we're not talking about risky investments or bad advice. We're talking about poor asset location, not allocation. And it's one of the most common blind spots that we see in retirement planning. So in today's video, we'll show you how it happens. I'll show you how to fix it and how one retiree unknowingly set themselves up to pay over $100,000 more in tax than they needed to just because they put the wrong assets in the wrong accounts. All right, quick disclaimer here before we go into deep on this one. This topic can get a little bit nerdy. And so we're going to try our best to keep this simple, but fair warning, this is where financial planning is going to be taken off the training wheels a little bit. Now, with that said, this stuff does matter if you care about doing the right thing at the right time for the right reason. There's a term in our world called the retirement risk zone. It's the 5 years before and after that you stop working. And it's one of the most important windows in your financial life. Now, why is that? Well, because the decisions that you make in that window can set the tone for the rest of your retirement. And one of the most common mistakes that we see in this phase is just focusing on only what you own, not where you own it. Now, most people understand the basics of investing, right? Like you have a mix of things, you spread out your risk, right? Like don't put all your eggs in one basket. That's totally fine. But what often gets missed is this: your investments don't all get taxed the same. And depending on which account you hold them in, maybe your RSPs, your TFSAs, or your non-registered account, the after-tax outcome can be dramatically different. And that's what we call asset location. It's just a fancy way of saying in what account do you keep your stuff? Not, do you own stocks or bonds, but rather in what account are those stocks and bonds sitting in? Because the account itself, right, how it's registered dictates how much tax you're going to pay on the growth, the income, and eventually on the withdrawals. And the crazy part is that most people never probably think about this. Whether they realize it or not, they've built their portfolio probably like a junk drawer. They bought what they liked, they put it kind of wherever there was space, and then they moved on. This might be no big deal when you're 45 and you're still building, but when you've hit retirement, that randomness can start to quietly cost you real money. Let's break this down simply. But first, if we haven't ever met, my name is Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help people like you plan for your own retirement, helping you arrange your investments, your income streams, and ideally pay less tax along the way. Most Canadians planning for retirement are holding their investments in one of three types of accounts. You've got your RSPs or your RIFs, you've got your tax-free savings accounts, then you've got non-registered accounts. Maybe that might also be called like an open account or a brokerage account, a cash account or a flex account. Lots of names for that one. Now, each of these accounts comes with a different tax treatment. And that tax treatment matters a lot more once you're no longer working and you actually start drawing on these accounts to fund your life. So to make this easy, let's use a traffic light system. The red light is your RSPs and your RIFs. These are going to be fully taxable on withdrawal, right? Think of RSPs and RIFs as like income tanks, right? Because every dollar that you pull out is going to be taxed like employment income. If you take out $50,000, that's going to be added straight on as taxable income in that year that you take that money. So the marginal rate that you pay might be 30%, might be 40%, it might be even more, depending on your other sources of income. And if you're not drawing them down strategically, these accounts can kind of sneak up on you, right? We talk about that a lot here on this channel. We've seen people defer their RIF withdrawals far too long, and they find themselves with huge mandatory RIF minimum withdrawals later on in retirement that suddenly pushes them up into OAS clawback territory, or maybe it spikes their taxes in their 80s. Now, these aren't bad accounts, right? RSPs, they did their job for you in their earning years. They've compounded tax-free until then. But in retirement, they do require finesse if you want to avoid a surprise tax bill. Now, on the other hand of the spectrum, you've got the TFSA, the green light, glorious, simple, and untouchable by the CRA. Now, everything inside this account grows tax-free. Every dollar you pull out is tax-free. It doesn't affect your taxable income at all, your OAS eligibility, or even your GIS qualification for the few who actually land there. You can think of this as your like free money bucket. And yet so often it's underfunded or misused, right? Especially by high earners who focused on maxing out their RSPs, but maybe they neglected their TFSA contributions along the way. It's also worth noting that this often is one of the best accounts to preserve for later, and not because the returns are better, but because of the flexibility and the tax efficiency that it's going to offer you as you age, right? Managing health costs and maybe supporting kids or grandkids. Now, the last bucket is that yellow light bucket, the non-registered account. And this is going to be the trickiest of them all. This is the one with the most nuance, but also the most opportunity if you handle it well. Now, unlike the other two, the tax that you pay here is going to depend on what kind of income your investments generate. And generally, there's going to be three kinds of income. The first is going to be interest. That might be from things like GICs or bonds. It's fully taxed to you at your marginal rate for anything that's earned in this type of an account. The second type of investment income is going to be dividends from maybe Canadian growth stocks. These are taxed better at a lower rate thanks to the dividend tax credit. The third type of income is going to be capital gains, and that's going to be from the growth of investments that are later sold. This is the best one of all. Only 50% of the gain is going to be taxable. So if you're holding interest-heavy investments in this account, you're paying top dollar. But if it's well-structured, growth-oriented assets, it can be really, really tax efficient inside this account. Now, we'll dig deeper into this in just a sec, but here's the kicker. This is the account that most often gets neglected. People will throw random holdings in here. They'll never review the tax slips, and they'll miss massive opportunities for optimizations. It's not about being perfect, but it is about being intentional. Now, first though, let's talk about what happens when your investments end up in the wrong accounts. And this is where we see the same mistake play out again and again. Like no strategy, no intent, just a random kind of scatter of investments across accounts that looks a whole lot more like a junk drawer than a well-built plan. And here's the part that might surprise you. We don't just see this from DIY investors. We see it all the time from people working with professional investment managers, right? Folks who've handed over their entire portfolio maybe to a discretionary firm only to find cloned holdings across every single account without any thought to taxes, no customization based on the account type, just a model portfolio rubber stamped across the board. And look, I've got grace for the DIY crowd. Like most of the time, it's kind of just a case of like, you don't know what you don't know. But if you're paying someone to manage your money and they haven't asked where those assets are held, or worse, they've just placed the wrong assets in the wrong accounts, that's a problem. That's not a quirk. That's just a miss. Because smart retirement planning isn't just about what you own, it's about where and why. And if your advisor hasn't had the conversation with you yet, well, you might be overdue for a second opinion. And when we're building custom plans for folks, we take a look through the filing cabinet, right? Looking for issues, enhancements, glaring blind spots, and like yeesh at the stuff we sometimes see. We've opened up client portfolios where they've got bond funds stuffed into their non-registered account, high growth ETFs in their RRSPs, and their TFSAs might be sitting half in cash and half in some random Canadian dividend stock that their buddy recommended. And when we ask, like, why are things the way that they are, it's just blank stares. Now, we're not here to make anyone feel bad. This is extremely common, but that randomness does come with a cost. Because if you're holding on to interest-producing investments like GICs and bond funds in a non-registered account, you're paying full marginal tax on that income. So if you're at a 40% tax bracket, you're giving up almost half the return before it even hits your account. Compare that to holding equities in the same account where the gains are taxed as capital gains and only half of that is included as income. And only when you sell. Like big difference. And this is where Ben Felix's research comes in. In a white paper he authored on optimal asset location, Ben walks through how placing the right assets in the right accounts can create a significant after-tax improvement, especially over long retirement horizons. It's not just theoretical though. His team models out different combinations and he shows that even when all else is equal, same investments, same asset mix, where you hold them makes a difference. To be fair, Ben Felix is a bit of a quant guy. He assumes long-term time horizons, low fees, consistent discipline, and he concludes that, generally speaking, tax inefficient assets like bonds or REITs are best placed in RSPs and RIFs, and tax efficient assets like global stocks are going to be best suited in TFSAs and non-registered accounts. Why is this? Well, you're sheltering the bad stuff inside tax-deferred accounts, and you're letting the good stuff live where it gets better tax treatment anyway. Now that's the math answer, but here's the real-world wrinkle. Not everyone has the same behavior. What if you put your most volatile holding in your RRSP and the market drops by 30%? Will you have the stomach to leave it alone, or will you bail out? You might lock in losses. You might miss out on the recovery. You might blow up your plan. Because the truth is, asset location math only works if you can stick with it. The moment you bail because you couldn't handle the ride, all of the optimizations in the world really don't matter at that point. So yes, smart asset location can help. It's a lever worth pulling, but only if it fits with your risk tolerance and your behavior. And that's why our approach is this. Asset allocation comes first. It has to, right? Your mix of stocks and bonds needs to reflect the ride that you actually think that you can stay on. And once that's dialed in, then we're going to place those assets in the right accounts for maximum tax efficiency, because that's where the real wins happen, right? Like not from chasing returns, but from keeping more of what you've already earned. So what does smart asset location actually look like? Well, this is where it's going to get a little bit more nuanced, and where I want to give a solid hat tip again to my friend and colleague, Ben Felix over at PWL Capital, who's done some pretty terrific research on this. So one of the key takeaways from his work is that a lot of what we assume is tax smart actually introduces new problems under the hood. So let me give you just a few examples. The classic rule of thumb always says, well, put your bonds in your RSP and your stocks in your non-registered account. That's the pre-tax math theory. And it sounds logical, right? Like bonds are taxed again at that highest tax rate, tuck them away where the tax man can't see them. But what Ben shows is that this approach, while maybe tax efficient on paper, can actually tilt your portfolio's after-tax risk profile, meaning you think you're holding a balanced mix, but in after-tax dollars, you're actually way heavier in equities than you might actually realize. You've unintentionally dialed up the risk, and that's not ideal if you're already in the retirement risk zone. Another insight from his work is just that yield matters. The more income an investment spits out, think bonds, GICs, REITs, the more important it's going to be to house it in a tax-sheltered account. If it pays out a lot, CRA is going to want their share, so you shelter it. On the flip side, investments that are lower yield have a strong long-term growth potential. Think broad market equity ETFs. They can often live just fine in a non-registered account. The tax drag is lower, and you still get to grow the pie. And then there's that foreign dividend wrinkle that often surprises people, or maybe even they don't even know about it. If you hold a US dividend-paying ETF in a tax-free savings account, you're likely losing a chunk of that dividend to foreign withholding taxes. But if you hold that exact same ETF in your RRSP, that dividend might come in tax-free thanks to some tax treaties that exist between our two countries. Now, it's not a deal breaker, but it's a detail that often gets missed, and it's one that quietly can drag down returns over time. Now, to be clear, this isn't about being perfect, but if you're in or maybe near retirement and trying to stretch your portfolio as far as you can go, these little shifts can quietly make a pretty big difference over time. And the good news is that none of this really requires a total overhaul, but it does require a plan. Because if you just kind of keep buying what feels right in whatever account happens to be available at that time, you end up with what I call the financial version of a junk drawer. Lots of stuff and zero strategy. Now look, I get it. Asset location isn't the flashy side of retirement planning, right? You don't get to show off your perfectly placed ETF at the dinner table. But this is one of those quiet levers that when you pull it thoughtfully, it can actually create long-term value, especially when you're drawing down your wealth instead of building it up. And so the fix is also pretty simple. Like take an hour, map out what you own, where you own it, and why. And if it doesn't make sense, that's probably going to be the signal that you need to tighten things up. And if you're not sure where to start, don't wing it. Ask someone who's been through it before. In retirement, clarity beats complexity, and every single layer of unnecessary tax is a layer of potential freedom that you might be giving away. So hey, that's all I got for now. A little bit headier this week. Thanks for sticking with me. I'll see you in the next one.